Okay. Okay, great. So thanks everyone for joining. And this is going to be a tradition for us in terms of having a Zoom call weekly. And, whether we have, 15 members joining with questions or 0 or 1 or 2, or 30, we're going to have the call. And the purpose of the call is going to be to twofold. One, answer any questions that we get from members. The way we want to answer questions here is in a generic way. We don't give specific advice at Bharosa Club. We give general advice. And so if one member has a question, most likely our answer will apply to other members. And so rather than limiting the benefit to just one member, we want to um, encourage a sort of communal aspect. And these videos will be available on YouTube. So you don't need to make the Zoom session. You can just ask your question via email. We can take up that question, answer it on the Zoom call. You can't attend the Zoom call, that's fine. You can catch the answer on YouTube. And that's kind of the way that we plan on doing things, because it becomes scalable for us also and allows us to keep our costs down, keep our fees low, and yet deliver good service to you guys, which is ultimately the goal that we have at Bharosa Club. So the second purpose of the weekly Zoom calls will be to apprise you all of new features as we roll them out. The exciting thing about the stage we're at as a company is we have a very lean team. The team consists of 3 people, and we are all extremely responsive to feedback from you guys, our customers. The other benefit is our customer base right now is limited. So your feedback is going to dictate exactly what features get built out and what features don't get built out. And you're going to see that. And already we're in process in terms of building out features that a few of you had suggested in the last Zoom session. So we've already built one, which we're going to roll out soon, which is this report preliminaries page, which will give you an idea of how your report was generated. So real quick, I'll just give you a quick overview of this. So the report preliminaries will begin with a sources of information. So this will be basically a summary of the CAMs that you submitted to us that we included in your report. So for example, here we have 1 CAMs from John, and that's why there's only 1 shown. But if you gave us 3, we'll have each of your raw PDFs available for you to download in case you want to go back to the raw data at any point, and you don't have to keep these PDFs on your side. We will keep them on our side, and you can download them whenever you want. The second thing is we will allow you to name the investors, because as we discussed last time, your report may have 4 different PAN numbers, and rather than have you guys remember 4 people's PANs, you can just do it once and you can assign a name to that PAN. So instead of seeing A, U, PB, whatever, you will see John Doe, and you can easily cycle through how you want to render the report. And then the last thing we're doing is we're giving you a table of what funds are included and excluded from our analysis. Like I discussed last time, we don't have 100% coverage on your funds. It's pretty close. We have a lot of data, but where we don't have data, we exclude a fund. So this can happen for a variety of reasons. One, if it's a segregated fund, oftentimes these funds will not have NAVs. And if they don't have NAVs, we don't know how to value that fund. So we don't include those funds in the report. And the second thing is that if a fund is very new, we may not have portfolio details about that fund yet. So that fund may get covered later in time, but it won't be covered very, very close to when that fund is sort of when the inception date of that fund is. So this table will give you a summary of your current holdings, what's included, what's excluded. So I think in this particular case, there are no excluded funds, but that can vary from customer to customer. So that's a quick overview of the preliminaries page. The second thing I wanted to do before we kind of open it up for questions and from the users that we've gotten is give you guys a summary of how to use the report, not from a features standpoint, but from a what do you get from it standpoint. So let's maybe do a quick walkthrough of that. So John Doe basically wants to understand his mutual funds, and right now is doing a combination of things. He's managing a part of his portfolio on his own. He's outsourced some of the management of the portfolio to an advisor. He's got a primarily active fund portfolio, and he has no idea how to analyze his portfolio. Why? Because the data just exists in 100 different places. It's not collated nicely together, and there's no way for him to actually sit there and do this by hand, right? So he comes to Bharosa Club and basically uploads his cams. We grab his cams details, we analyze every transaction he's done, and we analyze all the mutual funds he holds, and we basically give him the data to now do that analysis, right? So we won't tell John Doe, this is what you need to do in your portfolio. Rather, we will compile the data, we will present it to him in a way where he's able to make calls in his own portfolio. And the reason we do it that way is that actually when you make the decisions, you are in greater control and you know how to react when things don't work a certain way, right? If you rely on somebody else to make every decision for you, you're not going to understand when that decision proves wrong, when that decision proves right. But when you have the logic in your head of why you picked a fund, you will know exactly when to exit it. If the reason you picked that fund changes, if the fund manager changes, for example, or the expense ratio becomes higher, or the performance deteriorates, or you liked a sector, but now you don't like a sector. So you're going to be able to get much better results if you take an active role in your portfolio, and our tools make it easy for you to do that. So that's kind of the genesis behind it. We will move in a direction of helping you with some of our picks internally, but that's a little bit down the line. Okay, so let's see what John Doe gets from his report. Okay, so first we present John Doe with a very high level picture of his portfolio. How many of his funds are active? How many of his funds are indexed? Why do we break it up this way? It's a core difference in philosophy and strategy. When you go active, you are paying a premium. So generally you will see expense ratios before commissions of around 70, 80 basis points for active funds. And an index fund, on the other hand, you will see expense ratios from as low as 7 basis points to as high as 20 basis points, 30 basis points, right? But in either case, the index funds are materially cheaper than active funds. So why is that the case? An active fund basically is essentially saying that we're charging you a higher fee because we're doing more. We're actually picking individual stocks and bonds and not just trying to replicate an index. We are actually trying to beat the index, right? So that's why an active fund markets with a higher fee. They're saying our fee is worth it because we're going to beat the index. Now, what is incredibly hard to do with the current data sources prior to Bharosa Club is actually seeing, are your active funds managing to beat the index or not? With our technology, this becomes very easy to determine, and you can figure out which active funds are doing it, which active funds are not doing it, and do you want to switch those to cheaper index funds, which just aim to replicate the benchmark return, not beat it. Okay, so John Doe does the report. What does he see? He sees that he's picked 100% of his portfolio in active funds. So he's got a portfolio of 46 lakhs. All of that is sitting in active funds. He's paying an average fee of 70 basis points, right? So he knows he's picked the expensive funds. Now let's look at whether this is paying off or not, right? So he looks at the chart. He sees there's no return for an index fund because he's never owned one. He sees the active funds. Okay, it's posted a return of 12.73%. Is that good? Is that bad? How do you know? It's very difficult to know unless you know what the benchmark would have performed. Now, You may be saying, well, that's easy. I'll just look at the Nifty 100 performance, but that's not the right way to do it, because every fund has a different benchmark. A debt fund has a different benchmark. A short-term debt fund has a different benchmark than a long-term debt fund. A pharmaceuticals equity fund has a different benchmark than a small cap equity fund. So we do all that work for you. We basically map every single fund that you own to its benchmark, to the correct benchmark for that fund, and we compute the rate of return that the benchmark has delivered, that the composite benchmarks for every fund has delivered versus your portfolio. So you can actually see, are your active funds paying off or not? So in John Doe's case, he sees that he got a 12.73% return. Now, ordinarily, he wouldn't be able to answer whether this is good or bad, but with our technology, he actually can. He can say, see that the benchmark delivered a 12.9% return. So he has not beaten the benchmark. The active funds have not delivered in aggregate on their performance, on their promise to beat the benchmarks. So now this gives him some insight. Maybe he can look at saving some money by moving to index, right? So this is kind of what John is learning as he's going through the report. Now, John can play around with different time periods to see the performance. Our bias at Bharosa Club is to always look at the longest time period. Why? Because financial markets can be extremely volatile and random in the short run. But in the long run, there tends to be convergence to things that make sense, right? So you can see big run-ups, crazy increases in prices, crazy declines in prices in the short run, hard to make heads or tails out of it. But in the long run, logic tends to win. So our general rule is the longer the data set in finance, the more signal there is and the less noise there is. So, okay, so John understands this. Now, the next thing that we do is more than just benchmarking your funds. We also help you identify if there are any issues that you may want to think about in your fund. So we call this the optimization opportunity. So we run your funds through a series of tests, around 6-7 tests, which we think are issues that someone should think twice about whether if a fund triggers an issue, right? And we label funds that cleared every single one of the issues with the flying colors, healthy, and funds that trip an issue as caution. Now, one important note here, do not be alarmed if you see most of your portfolio sitting in caution. Most funds have tripped because of the tests that we have. When you're running 6-7 different tests, the odds are that one fund will trip on some issue. So don't be too alarmed if you see that a lot of your funds are caution. It just means you need to take a look. It doesn't mean you need to dump the fund. It doesn't mean you need to sell today. The reason we're using the term caution is you need to look at it, you need to understand it, and you need to make the call of whether it's worth it or not to have this fund. So, okay, so now John basically looks at his portfolio. He has no index fund. So we're seeing 0 healthy, 0 caution. Next, he clicks on active. Suddenly, when he looks at active, he's seeing that, okay, most of his funds are caution. Okay, he's not going to panic, but he's going to want to understand why are they caution? Do I agree with Bharosa Club's analysis? Do I think these are really caution funds or not? Right. So he's now got the ability to get a second opinion on his portfolio and funds. So he can look at his total portfolio, active or index. So, okay, John goes now to the nitty-gritty section. This section is about getting him into the details. We now can go fund by fund and see what the issues are, etc., etc. Okay, so John is using this tool now, and he's seeing that the table is sorted by share. So how big or small a fund is in his portfolio, but he doesn't like that. He wants to sort by issues. I want to see which funds have the highest issues or lowest issues. So he sorts by issues instead. Okay, and he can see which advisor put him into this fund in case he's curious about that, right? So, okay, so he sees this SBI blue chip fund has a lot of issues and it's pretty large. It makes up 14% of his portfolio. So he says, okay, let me look into this. Do I agree with Bharosa Club's and analytics, or, is it okay? Because our analytics are automated, right? So either it fails or passes a test. It's binary. It may fail a test by one smidge, and you may not care, right? So you always have to use your discretion. So, okay. So he clicks it and it shows a summary of the tests that were failed and the tests that were passed. And if something does not show as shaded, it means that that test wasn't performed for this fund. So an AUM test, for example, is not relevant here. So it was not performed. Okay, so we open this up to get details on the tests and we can see, okay, performance. This fund has posted a 13% return versus 14.3% return in the benchmark. Okay, that's much lower. On top of that, I'm paying a pretty high fee. While it's in line with the category average, it's still a high absolute number, right? So, I'm paying 1% of my return for a fund that's not delivering me better than benchmark returns. And all of my money is sitting in a regular version of the fund. So my fee is not just the 95 basis points, it's the 95 basis points plus the commission. I don't like this. I'm going to look into this. I want to get more details. So John then clicks more details. Here we show the same test data, but for more time periods. So here you can see the 5-year benchmark comparison. It is underperformed. In 3 years, it's slightly outperformed the benchmark. And over the last year, it's underperformed the benchmark. So again, this is drawing red flags in John's mind. He's saying, man, this fund is really not showing signs of turning a corner. It's not delivered. Expense ratio also is kind of static at 1%. It's not changed. And then he looks at the hidden commissions. Oh my gosh, I'm actually paying 1.67% when you include the hidden commissions, right? So now John has a very clear idea. He needs to do something about this fund. So he can add this to his list of funds that he wants to exit, right? So that's how John is using this tool to make a decision about what he wants to do. Now, one of the suggestions we've got from people is, this is all great, but what do I do once you tell me a fund is, unhealthy? How do I replace it? So we are working on tools that will help you explore funds to find good substitutes. That's still a little bit ways away. The first pass of these tools you'll see probably in the next week, I would say, but that's just scratching the surface. We'll keep releasing more and more, but just be patient with us. We will keep improving the level of the tools that you see. And once you've paid for a report, you will automatically get upgraded as we add tools. Your report will include the new tools as we release them. So you don't need to worry about, oh, well, I bought a report last week and you released this week. Am I not going to get it? You are going to get it, so you will have access to those new tools as we release them. Okay. So that's kind of how he uses the nitty gritty health check on the fund. That's great. But okay, let's move on. Okay, so here we have a performance evolution chart on the performance tab. This shows John, how has my portfolio performed versus the benchmark over time? So we start at 5 years ago and we show a cumulative rate of return for the portfolio versus the benchmark version of the portfolio. So you can see initially for short periods, John was able to beat the benchmark. But as you get further and further in time, it becomes harder and harder to beat the benchmark. Why? Because in the short run, just by luck, you could beat the benchmark, right? But over long periods of time, it becomes very difficult because luck averages out, right? It's like flipping a coin. You can flip 2 tails in a row, but can you flip 1,000 tails in a row? No, right? So over longer periods, these things average out and your performance tends to converge to the benchmark. And because John is paying a fee that is high, he's going to trail the benchmark usually by the amount of that fee, unless he's demonstrating some real skill or his managers are demonstrating some real skill and being able to beat the benchmark. But that is very, very rare. So, okay, John's now getting convinced. He's seeing this data. He's saying, man, okay, I got to figure things out. Now I got to figure out what funds I'm going to get in and out of. So this gives him another data point. So this chart shows you exactly which funds have beaten and failed to beat their benchmark over different time periods. You can select the time period up here. Okay, so John can look at different time periods. John agrees with Bharosa. So he's going to look at 5 years because he thinks it's the most meaningful. And he can see that, okay, which funds are the real problem ones for him. And he can dive in. So he can see the Starter Equity PE fund that has trailed the benchmark by 2.25%. So he can say, okay, that is one that is on my hit list, right? So this helps John get another data point in terms of whether he wants to get in and out of funds. Okay, great. John's making some progress. Now he goes to asset performance. John is trying to figure out, okay, I have, how much should I have in equity? How much should I have in debt? How much should I have in liquid? How have I done in each of these asset classes? I don't know. We tell him, we tell you exactly how you've done in each asset class. So John can know, okay, equity seems to be giving me a good return, but actually most of that has been due to timing. It's not been due to my fund picks, because my fund picks are actually trailing the benchmark by a very large margin. So 82 basis points. So maybe, I think I've been doing great in my equity portfolio. That's really due to timing, not which funds I picked. He can also see his returns for debt. He can get an idea of what each asset class has given him. So he thinks about his asset allocation in the future. So we can show you the same data for performance for any asset class over time. So John can see exactly how he's done on each asset class. Now John goes to asset mix evolution and he realizes, oh man, I've actually moved a lot of my portfolio to debt. And if I go back to this chart, equity gave me a phenomenal return. So should I have done that, right? And maybe the answer is yes. Maybe John suddenly had a new baby and he's going to have some short-term expenses, and that's why he moved to debt. Or maybe John just panicked during the pandemic and moved a bunch of money into debt and forgot to move it back into equity. This helps you stay on top of your asset allocation. And John can now figure out, is this good or bad? And is this asset mix appropriate for me or not? And as you'll see later, we'll have more tools to help you answer that question. Okay. Now, John, as we mentioned, uses an advisor for part of his portfolio and uses direct investing for his other part of his portfolio. Now he's learning something fascinating. We show you here the performance of the advisor and the performance that he's achieved directly. And what John has learned here is that, my advisor has trailed the benchmark while I have beaten the benchmark. So you may look at this and say, wait, Sahil, how this doesn't make sense. Why are the benchmark numbers so different for direct and for advisor? The reason is you can't use the same benchmark because maybe the advisor is managing John's debt investments and maybe John is managing all his equity investments. It's not fair to compare the absolute returns there. You need to look at the deviation to the benchmark. And in this case, John is realizing that his advisor is actually doing worse than he is. So maybe he's saying, you know what, I'm going to sack this advisor. And he can even see how much he's paying his advisor in hidden commissions. He's paying 21,000 rupees for, service that's not getting him anywhere. So that's what he can do there. Direct versus regular, John can see how much he's paying over time. He can see that it's increasing. Why is it increasing? His AUM is increasing. And these fees are paid as a percentage of AUM. So what starts as a small fee compounds and compounds and compounds as your portfolio grows. So these little changes can have very big impacts on your portfolio. Just saving 1% per year in commissions and costs and all over a period of 5 years can swing your portfolio size by between 10 to 15% once you take into account compounding. So that is the power of compounding, and why little changes can create enormous changes in your wealth profile. So here John can see he's not been good about getting out of regular funds. And now that he realizes his advisor is not providing great service, maybe he'll move his entire portfolio to direct. Here you can see how much he'll lose on a fund by fund basis. Okay, so there's some other stuff in the report, but I think I just want to give you a sense of how to get value out of the report, right? Okay, so now the big picture. So John has been focusing on the tactical details of his portfolio, fund level details and all this like nitty gritty stuff. But a really important decision is, what should my asset allocation be? Where should I be investing? How different is my portfolio than the average? And what am I betting on at the end of the day? When you roll up my entire portfolio, when is it going to do well? When is it going to do badly? And do I want to be betting on those things? It's very hard to do, because if you're in 15, 20 different funds, at the end of the day, how does it all roll together, and when, and what are you essentially banking on in the future? Our tools help you answer that question. That's the goal here. So first thing we show you is your portfolio asset mix versus the market average. Okay, so we can see that John's portfolio asset mix wise is a little heavy on debt, right on in terms of equity, a little low on cash. Right now, John may realize that's fine. I have some cash sitting in an FP, so my cash reserves are okay. I don't need more. But then John may look at this and say, actually, I'm pretty young. I don't have any fixed expenses, and I live a very frugal lifestyle. Maybe I should be more aggressive with my equity, right? I mean, why am I sitting at the market average? I can keep my money in the market for a long time, and I don't need to worry about ups and downs. So maybe I should shift more of my money into equity. So, okay, let's see what happens if you shift more money into equity. So what we do here is John is able to see at different equity mix percentages with his actual portfolio. This is not indexes or anything. There's actual funds. What would have happened at different equity mixes over the past 5 years, both in terms of return and volatility, because we often make the mistake of only focusing on return, forgetting that if a downturn hits, when you're sitting in equity, you can get smashed, right? So let's see the impact of that. So John says, okay, I know I want to increase my equity mix, because you know what? I can live with a 22% maximum peak to trough decline. I won't like it, but I won't panic. It's fine. My entire portfolio is fine. I have cash reserves, etc. It's okay. I can leave that money untouched. So it's not a problem. But then he increases it. Can I live with 100%? No, I can't live with a 40% peak to trough decline. He says that that's too high. Even if my return climbs to 14, 15%, it's too high, right? So John can find the optimal mix with back testing here and say, okay, I like the profile at 70%, right? And if he wants to zoom in on the downturn and see, really get a sense of how the equity mix impacts the volatility in the downturn, he can get a sense with actual data of how impactful this decision is and what the trade-offs are. Okay, so now he gets it. He's realized 70% is his equity mix. Okay, where is that 70% going? How does his portfolio compare to the average equity portfolio? He can answer this question here. So he knows now that he's light in finance. Maybe he thinks that's good. John doesn't like the finance sector. Okay, he doesn't want to be in finance, so he's fine with that. Or maybe he says, you know what, I don't have a reason to be light in finance. Maybe I should add some finance, because if I don't have a reason to be different than the average, I should be betting on the average. Because if I am different, I am betting on finance underperforming, right? So that's how I would use this tool here. Figure out why you're different, where you're different, and figure out, do I want to be different in that way? And if you're not, work to make your portfolio less different. So that's the kind of principle I would use here. Don't be different unless you have a reason to be different. And if you have a reason to be different, be very cognizant of what that reason is, and then be different, right? So you can do the same thing in terms of large, mid, and small. John can see that he's heavy in mid and small, and he can say, do I want to be, right? And he can see what the top securities are that he holds in his mutual fund. So he can say, okay, I didn't realize that I own 6% of my portfolio is holding ICICI Bank. So maybe when I buy individual stocks, I want to stay away from ICICI Bank, because I already have ICICI Bank in my portfolio via the mutual funds that I hold. Okay, so we do similar analysis with debt here. So I won't belabor this, because I want to leave ample time to answer questions. But that's basically how I would use the current tools we've developed. More to come, more to help you explore, find new funds on the horizon. So with that, I'm going to open it up for Q&A. So Mami, do you want to moderate that?
Yeah, sure. I would suggest that everyone just unmutes themselves when they want to ask a question. So
I
go
think
ahead.
I had some write-in questions also, right?
No,
So
I answered those. They were nothing. They were very specific.
no, via email also some came in.
Yes, let's take the questions directly from, and then I will ask the
Okay.
questions.
Huh.
Okay, let me go first. I just want to clarify, Sahil, when one looks at, let's say, the performance,
Mhm.
the value, is that the market value or invested value?
So performance tab. Let's go to the
So
action
I've
place.
gone into nitty-gritty, and if I click on the performance tab there,
Or
the value
that,
there, that's
huh.
the market value, is it?
That is the market value, not your
Okay,
cost basis.
it's not the cost basis.
Would the cost basis be helpful? It's a good suggestion, actually. We can add the cost basis also.
It just for one to sort of remember that how much did you
Yes,
invest and where things stand, and
it's a good suggestion. Ujjwal, just keep notes as we're on the call. Just so cost basis is a very good suggestion. It will help someone realize also if they have a huge gain for tax purposes.
yes.
So cost basis is a very good one.
In fact, that's the other one I was coming to. In
Sure.
the old website, you had the option where you could see the tax-free units
Uh-huh.
held in a
Sure.
fund. Of course, the thing is it has to be held before for 3 years, but
Yeah.
there could be some investments made in the last, let's say, 12 months.
Sure.
So how does one be able to access that information now?
Sure. So the old website is still running. So you can always go and access it via that. But
Okay.
the short answer to your question is we actually do show a free unit summary somewhere. It's not in a lot of detail, but here. So if you hover on the
Okay.
fund health page, you'll
Okay.
see how much of the holdings are STCG and LTCG. But
Okay.
this is not, you in particular have I think, number of different pans and all that.
Yes.
So
Yes.
this,
Yes.
you will need more detail. So the short answer to this is we are actually, I was talking to Anita about this today, that we need to build a capital gain summary also. So that is on our feature list to roll out in the future.
Okay.
For now, I would use the existing website to get a lot of detail. And if you just want a high level view, you can hover over the name in Fund Health to get you that data.
But tell me, if I were to action and I want to sort of initially exit units which are tax free,
Yeah.
how would I get a sense of that? Means if I were to, let's say, use MFU to exit part holdings, because let's say I can figure out that if I wait for 6 more months, the remaining units will come through, but there's some units currently, so
Yeah.
it's not a good fund to keep holding on to based
Sure.
on the various tests you're showing me. Is there a way to get that information so that when I go and execute it elsewhere, I am holding enough information to do it correctly?
So currently the existing site should give you that level of detail. I think Anita can speak specifically to the old site because she knows exactly what's on there. But I think the lot level information will be on the existing site in terms of what the dates are, when they will turn free, all
The
that
new one,
stuff.
the new site you're saying, or the old one?
No, no, no. So it's there on the old site.
There it is.
I think we will have to build it into this site.
Yeah. Right now there's just the summary level
I think
detail.
Sahil, if you just added one more column to this saying LTCG.
I don't think that's we can add that, but I don't think that's sufficient because you really want to understand this on a pan level, because
Yeah.
multiple pans could be holding the same fund. So to really do it properly, it'll require us some time, but we will roll out a cap gains.
Okay. No.
For now.
The old site you said would be active till August 1, right?
No, May 15th.
May 15 this year. So,
Yeah.
but subsequently, if you could sort of have that option available, because it's quite possible, given where the markets are behaving, one may not do any action right now.
Sure.
And may want to sit still for things, volatility to settle down.
I don't think it'll be, you won't be left naked in terms of capital gains functionality, like in the sense that when I say it'll take us time to build, we are very rapid at development. Like,
No, that's fine.
so we will probably roll out the cap gain statement, I want to say, at the end of, no later than the end of this month, right? So we'll
Sahil, there are two different things. One is the capital gain statement based on your redemptions, right? The other is
a tax summary statement I'm talking about, including the free units and lot level.
Basically, if I'm going to go and do some exits, and I don't want to do it in one go. Let's say there is the bad apple in the basket.
Yeah.
Maybe I just don't want to chuck the whole thing and take on any.
I actually understood the requirement. I think that's we'll have to work on it at a PAN level.
Okay. And the other one was in terms of the fees, right? Means, of course, the number of number of units I'm holding as through regular investments involving fees is now very, very small. But even in those can be identified, or one still will have to use the old site for the
no, regular will show up. So anything with an HC
is a fees involved, right?
Is a regular scheme. So basically it stands for hidden commission. It means you are in a regular scheme in at least some portion of your holdings in that fund. So you can use that to identify where you may have some small regular pockets.
Still, okay. And then go and dump.
So it's a little counterintuitive. We want to improve the UI a bit, but just so it's clear for everyone, to get the detail, you have to click the fund. Okay. Then this comes up. Okay. And then you click this little caret here, this little chevron, this little arrow. And by clicking the arrow, it expands down and gets you detail. And then you can jump into more details by clicking here. Okay.
No, and also to the left where you see John Doe written, you can do things at the PAN level.
No, that's what I'm doing.
Yeah.
That I figured out, yes.
So I think, Sahil, to address Subbu's issue, we could at the PAN level, but no, it won't work because we have multiple folios for the same scheme also. Okay, we'll figure it out.
Don't worry, I know.
There's no rush. I'm not running into. I'm just.
No, we understood the requirement. I think that's very useful. We have to figure how best we can give it, and it can be done.
Basically, we will have an exit advisor of sorts, which will say, okay, you've decided to exit this fund. Here's everything you need to know about what PANs are holding this fund, what the lot level detail is, when it turns free, all that stuff, and to help you plan your exit.
Basically. And one last thing again is when you go to the big picture, right? Now, for instance, as you know, in my case, there are a couple of different PANs. Now, in the earlier one, you could sort of specify what's the risk level, right? Means if, for instance, my mother's portfolio, she's a retired person, so her debt component would be a little higher than otherwise. Now, when you're doing a comparison with the market average in this case, how you sort of, are you assuming the previous sort of, low risk kind of approach to a particular portfolio and then comparing? Is it apples to apples, or is it the market average is the market average now you figure out with your portfolio?
Exactly. It's the market average. It gives you a sense of where you compare to the average asset allocation in the market, which basically is you sum up all the AUM deployed in equity, all the AUM deployed in debt, all the AUM deployed in gold, and in this case not physical gold because we don't have that data in our system, but gold funds, and all the money deployed in liquid, right? And you see what allocation the market has, right? So you understand where you compare to it on a weighted average basis.
Fair enough. And but then is there an option to look at, like you did earlier, where you say that, okay, I'm looking at a person who is going to look at, a slightly lower risk portfolio, which means No, not really.
So we don't get into risk profiles and all that stuff. That needs to be done very carefully, individually. Uh, I'm not sure exactly what you're referring to earlier.
No, actually, Subbu,
Hmm.
if you select the like you were mentioning your mother who
Mhm.
has a lower risk profile, right?
Mhm. Yes.
You select only her PAN, okay?
Yes, yes, that's what I did. Huh.
And then you see her portfolio compared to the market average, right?
Yes. Uh-huh.
Then you will see that if truly she had a lower risk profile and you were sticking to the investments in that strategy,
Mhm.
it should be way below the market average for equity, right?
Yes.
I'm not clear what the question
Yeah,
is.
I'm actually not sure. Now I'm confused for the question.
Okay. No, no, no. I'll tell it. Sahil, basically, it's like this, right? Means, let's say my portfolio, I have consciously have a higher allocation to equities.
Mhm.
But in my mother's portfolio, there was a conscious thing to have a higher orientation towards debt.
Mhm.
Having decided that, now when I look at her portfolio and see that it's not matching with the market average, I'm a bit confused when if that market average is, because I'm only looking at one portfolio. There are 3 pans in there, but if I'm looking at one pan,
Mhm.
then the market average is a market average which would be same for all of us, or is it tuned to
Same
the
for
fact
all
that
of them. It
okay,
literally
okay,
is the market average, right?
okay,
It basically helps you understand,
okay,
are you higher or lower than average, right? And how much higher or lower than average? We don't tailor that average because we don't know, right? I mean, like, uh, we don't know it's your mother's pan, right? Like,
okay,
we just know that it is a pan,
okay,
and we don't know what your mother's risk level is also, right? Because we have never taken that insight. So what you're getting at actually is something that we want to do in the future,
okay.
which I think will be very helpful for answering your question, which is give you cohort level detail. So your mother maybe, I don't know how old she is, Subbu, but let's say she's
75.
75 years old. Okay. So for people between 70 to 80, what is the average? For people 50 to 60, what is the average? We want to move in that direction, but that's still a ways away. And for example, AUM sizes, I want to know for X to Y AUM, what is the market average? I think that's what your question is, right?
Yes,
Oh,
yes.
But
see,
we
there's
Because
another point here.
people would want to look at it, the portfolio differently, let's say post a certain age or post
correct,
retirement, or
correct.
assuming that I decide to retire tomorrow,
Yeah,
then I would want my portfolio to change because my requirements will suddenly change.
correct. So I think
So,
I think we
is
will
there a
get,
way to build something like that?
once we have a significant user base, the
Fair
plan is
enough.
to calculate all that information. Right now, we don't have enough data to give that insight, but it would be very helpful to all people to get that data. So
So
it's
there's
not
one
perfect.
other thing to consider, and that is that different people, even for the age bracket, will approach things differently. Like, say, in your mother's case, you may say that, look, she has adequate money for her lifetime. So her savings are really meant for, say, her grandchildren, in which case, should her profile be aggressive or less, conservative is an individual decision, right? So, but having that cohort level data, so, let's say that there are many people, who are in Bharosa members, and then you find it very surprising that 80, like this person is over 80, but in the Bharosa members, people over 80 have like 80% of their equity in have an 80% allocation to equity, which is contrary to the 100 minus your age kind of thing. So that may make you think. That doesn't mean that you have to do 80, but it'll make you think, as to saying, why is this like this? And one other point on the tax thing. So there are two parts. So one is tax, the other is exit load. So in the exit advisor, one should look at exit load and tax.
Yes. The complication with exit load is our data source does not have that stuff coded very well, because exit loads tend to be very complicated in terms of some of the bells and whistles and all. So if we can get confidence that our exit load data is correct for, you know, the vast majority of cases, then we may include exit load information as well. Otherwise, it's something that we will note that you need to check in addition to what we're doing.
But I basically, you know, my experience has been that once you've decided to exit, you are saying, okay, I am willing to take that exit load it and move on. So
Yeah, but
it's
actually,
less.
actually, it's a good, yeah, it's interesting you say that, because I've seen portfolios where people have gotten rogered by
Okay.
the exit load, because they, for example, we saw a portfolio where someone got into a regular scheme, okay, realized they were in a regular scheme, sold it quickly, paid the exit load, and then moved it into the same fund in the direct scheme. If they had waited 3 more days, they would have saved the, you know, exit load. So it's, it depends on the.
No, but that's what I meant when I said units free of some of these things, because one has seen that, you know, the earlier website, one could see a lot of these things very carefully, and you know, where it said, you know, the hit was the least, one would sort of.
Yeah, but I think the earlier website was not, it was just assuming exit loads per se. I mean,
Okay,
it's
okay.
not, we didn't have.
No, ours was not considering exit loads. It was considering
Fees and tax.
no, the 3-year cliff or the
Okay, okay.
basically.
Which is all
Exit load
changed.
is very tricky, because
Exit load is very tricky. Yeah.
it's very complex in terms of the bells and whistles that different funds can have, and codifying that in a way that is structured and utilizable by technology is very difficult. So if we can do it in a way that's scalable, we will include it. Otherwise, it's left to the customer to analyze. But yeah, I think increasingly most funds are getting pressured to simplify their exit loads and make it less of a consideration. So hopefully that continues. So,
and I have one very last question, which
Yes,
is which is that you know, let's assume that I were to use MFU for the actual transactions. You know, when I exit, do they go by FIFO, first in first out, or you know, one has to now start specifying what units, because it will be very complicated.
I think and you should verify this, but I believe all over the industry, wherever you do it from, it's the same. So first in, first out.
No, so let me clarify.
That's when you,
That's not the correct answer.
That's when you do your tax,
No.
right? You are specifying. They don't care.
Listen, let me address this. So the thing is that from a strict tax standpoint, if you use a demat account, it is specified that you have no choice but to do first in, first out. If you do not use a demat account for your mutual funds, so if you buy your mutual funds from Coin, Zerodha, that kind of thing, and you're using a demat account, then you have no choice but to do first in, first out. However, if you use something like MFU or whatever, and you're not using a demat account and you're doing mutual funds, okay, then it's a gray area. But the mutual fund site will not basically, or our site will kind of assume first in, first out. But when you file your taxes, you can do adjustments based on your allocation of units. Okay, so I have, when I file tax returns, done that. So far, I have not been questioned. And
okay, let's get this.
Yeah,
this is way beyond the scope. We are not giving tax advice. Okay.
Yeah,
since it just came up. Yeah.
Okay.
So anyway, that's what one will have to then check with MFU and,
No, so
work out what
MFU
is the
doesn't
best.
come in the picture, nor do we.
Okay.
Right. What
They
I'm
don't
saying is
mark- they
basically
don't mark the units.
MFU does
Okay,
not give
okay,
you a
okay.
capital gain statement. Okay. They just tell you, okay, you exited here, is this thing, and whatever you have to generate your capital gain statement.
Okay. Or I go individually to the specific mutual funds and
Even then,
exit. Okay.
so some mutual fund AMCs may give you a capital gain statement, but in other cases, they will just give you a.
I think Subbu, where you're missing the thing is in mutual funds, forget the DMAT ones, the non-DMAT ones, you are just exiting and in a folio, the total amount of units gets reduced.
Okay. Okay.
Now we in our Bharosa, in our capital gains statement, do first in, first out. Okay. Now you may choose to do it differently.
Okay.
That is the question of how you file your taxes.
Okay. Okay.
But
Cool. Understood.
Yeah. Yeah. Okay.
Yeah, and
That's it.
Our knowledge, MFU does not produce a capital gain statement, and quite a few AMCs also do not produce a capital gain statement.
Okay. Next question. Subbu, do you have more questions, or we can go over to Suresh?
No,
now?
I'm done. I'm done.
Okay, Suresh.
He has to unmute.
Yeah, I'm trying to.
Hello, everybody. This is Suresh here.
Yeah, hi.
I'm glad I joined, though a little late. I really don't have any questions as of right now. I think a couple of sessions, I'll join you with some reasonable questions. But I'm trying to follow up all the things. But the thing is that I was worried that we are moving out of Bharosa Club, and we are going into an issue like I'm going to consult you only once a year or maybe twice a year. But going forward, I think I will be having some questions and I will surely let you know. And in the future Zoom meeting, probably I may raise some questions. Thank you very much for asking me again. Thank you.
Thank you.
So Suresh, just to alleviate your concerns, so when we say once or twice a year, we mean that, look, we don't recommend you do a deep dive like this too often, because things take time for signal to emerge in your portfolio. If you look at this report now and you look at this report 1 month later, not a lot is going to change unless you've done some big moves. And even if you've done big moves, it will take time before your portfolio sort of reflects that, because it takes time for divergence to occur in finance, right? So that's what we mean. We mean you shouldn't be doing this report compulsively, right? We are saying that maximum, do it once a quarter maximum. And if I were doing it for myself, I would do it twice a year. And in terms of like getting value from Bharosa Club beyond that, we are going to be bringing in some of the tools that people liked, right? So that you can use them like you were on the old site, right? So not transacting, because we are making a conscious decision for many reasons to get out of transacting. Not economically feasible for us to do transacting, but compare schemes, for example, exploring funds, features that members liked. We will do our best to accommodate them in the new site, such that you're able to get that value anytime you want after you've paid for one report, right? For 12 months, right? So you pay the fee once for a report, you get access to compare schemes for 12 months, right? And you can use it whenever you want, right? So that's kind of the direction we're probably going to go. And compare schemes, my best guess is that by next week's call, or maximum next week's call, we will be pleased to be introducing to you the new version of compare schemes, which will hopefully be new and improved. So that's kind of the pace of development we're also looking at. And like I said, you purchased a report in the past, we came out with a new feature in the future, you will get that feature, right? We are not going to, we want to reward people that take a bet on us early, not penalize them, right? So so that's the kind of plan there.
Okay, Sahil, there are a couple of questions that had come in on email. One of them is, what about stocks?
So stocks, like I mentioned in the last call, our technology is ready to go with stocks. We can very easily replicate this report for stocks, provided that we had a smooth way to get your stock information into our system, right? Which doesn't exist yet. So stocks is very much on the radar. First, we want to get everything smooth on the mutual fund side. Then we will put our resources behind figuring out a good way to port your stock data into our system.
Okay, the next question is, what actions should I take based on my report, and how will Bharosa help me in optimizing my mutual funds? Can I get started right away? And why should I join the waitlist for optimization?
So in terms of, will we help you decide what to action? So I think the current state of the report, it will identify issues and suggest to you logical places where you need to change your portfolio. That capability, I think, is very well sort of demonstrated in the report. Where we are going to work on getting you more insights is in terms of, okay, now suggest some alternatives to a fund that I've decided to exit, right? And that's kind of where optimization will come in. And optimization will also take into account some of the things that Subbu was asking about in terms of how to exit these funds, right? And again, we will never take the approach of do this, right? Because I don't believe in that philosophically. I don't believe that you as a customer can abdicate responsibility of your portfolio, because it's not healthy for you to do that. Because finance involves a lot of uncertainty, it involves a lot of judgment. You should never be trusting someone to make decisions completely blank check, say do what you want. Like, that is never a good approach in finance, right? So we will never do that at Bharosa Club, because I don't think it's good for you guys, right? What we will do, and what we will keep trying to do better and better and better over time, is helping you make the decision by collating data that you need to make the right decision, right? And then you make the decision, right? So we'll show you, okay, here's the fund that you want to exit. If you want a similar fund, here are some options for you, right? But we're not going to tell you this is the fund to pick, because we don't know. We can use some parameters to help you make that decision. Do you want a low cost fund? Do you want a fund that's beaten in the past? We don't know if it's going to beat in the future. You need to make that call, right? No one knows, right? You have to make that call, right? So that's kind of the way we will look to help you on optimization, give you the data points, give you all the data you need to make that decision, present it to you in a way where it's easy for you to make the call. But then at the end of the day, you need to make that call, right? And you need to stand by that decision, right? So that's where I think we're going to go with optimization. You should join the wait list if you believe in that sort of thing, and you want to endorse support for our vision of optimization. Because if we find that there is no one on the wait list, and there's not interest in doing that, then we probably won't build optimization, right? So it's a good way for you to express interest in it, support for it. And we are also thinking about ways to reward early customers in terms of potentially things where you get to lock in pricing, etc., etc. But we haven't finalized on any of that. But we very much realize that early adopters are making a bet on the company, and we like that, right? So, and we think customers play a critical role in our success. So that's kind of my view on why I would join the waitlist.
Okay, I think that's it for the questions. There's no more questions. So maybe we can end this call unless anyone on this call has any more questions that suddenly came up. Okay, so I think we're good. Thank you, everyone, and see you next time.
Yeah, see you next week, where we will hopefully be introducing to you new features, and hopefully we'll be doing it at a cadence where every week we have something new to talk to you about. That's the hurdle we're setting for ourselves. Let's see if we can meet it. All right, great. Thank you, everyone. And thanks for supporting us, and hope we deliver for you, and we'll do our best. Bye-bye.